Joining us right now is Jeremy Siegel. He's professor emeritus of finance at University of Pennsylvania's Wharton School of Business. He's also the chief economist at Wisdom Tree. And Jeremy, a new day, a new outlook. What are you thinking after what we heard over this weekend with the China talks?
Amazing, Becky. There was no analyst out there that predicted that we'd come to agreement, at least a tentative agreement, so quickly and actually specify tariff levels as low as they came in. Remember, within the previous 48 hours, Trump was saying 50%, and he was saying 80%. It was almost like Scott says, hey, Donald, it's 30%, and Trump says, okay. I mean, it was like, wow. And I think that really, I mean, this is great news. I mean, I think it's settled down at that. I mean, I don't think we're going to get the reciprocal tariffs back. I don't think we're going to jump up on China or anything. I think we're seeing, the 10% base, the 30% on China. There'll be small adjustments. Now, this does amount to a 17% average tariff, which is the highest in 85 years. For the United States. It's not going to have zero effect, but it's certainly going to have a lot less effect than, what it seemed like just a week ago.
No analyst may have predicted this, but the president, Donald Trump himself, told people to buy ahead of it. Yeah. He thought there was going to be a big deal that was done. I guess I wonder what you think about what happens the next 90 days. If those discussions get more complicated, if there's a willingness on both sides to actually make this work, or if you think the 30% tariffs get put on at the end of 90 days and what that would mean.
I don't think they jump up again. I think they've got to a working relationship. I think we also have to face the fact that with a 17% average tariff, that we are going to have more inflation this year. As I said, I don't think longer term, but there is going to be a bump of maybe a percent and a half on CPI and a reduction in growth. Now, certainly Goldman Sachs and all the analysts and myself have somewhat raised our real GDP estimates, but Goldman raised it from 0.5% to 1% for this year. Now, that's still 1/2 of what we thought at the end of 2024. So there is going to be an effect. Earnings are not going to be up as much as we expected in 2025. Now, for instance, we're getting the CPI, I guess, in a little more than an hour. Again, I don't think we're going to be seeing the effects of this tariff until maybe June or July, because so little actually did come into this country and then get priced at the retail level and then sampled by the government officials to get in. So, yeah, I think we're going to probably get about a normal rate, probably, 0.2 or 0.3, but I don't think this tells us what really the effects of those tariffs are. I think the good news is that I think that the tone of Trump is so much different now than it was 2 or 3 months ago. He seems to be much more willing to go to a deal. Frankly, I think he realized that the reaction, not just of the market, but a lot of his constituents was, hey, what's going on here? You're disturbing our supply chains, and now I think it's smoothing out.
You were, we always get criticism for being a perma-bull. The one time you should have been a perma-bull, I don't really think you were. But didn't you think we should have cut rates? Are you glad we didn't now?
No, I'm not glad that necessarily we didn't. I mean, listen, I think the Fed should be far more flexible. If things look bad, they could cut rates, and then if things look better, they could raise rates. I think they go way too slow and way too. Yeah,
you mentioned the money supply and everything else. You were very, and I agree with you on that.
Yeah, and that's why. I mean, we can take a look now and see, how things settle down with the CPI, but money supply is just not growing fast enough. Loan demand is not growing fast enough to produce the type of economy that the Trump administration wants. We're not in an inflationary cycle.
You just said that we're going to see more inflation that you think catches up in June or July. It's not going to show up until
this is
then.
Short term, though. This is supply. This is tariff induced inflation. And, as I mentioned here last time, long-term inflation rate indicators are not going up. And the Fed should not be reacting against a supply shock. It should be reacting against a demand shock. And we're not getting a demand shock either from the tariffs or the fiscal policy or money supply growth. So, again, they have time to consider this. But I'm still for a much more flexible short-term rate rather than this thought that, we reduce it 25 basis points. This is the start of a huge cycle. We can't be wrong. And we have to wait until the data hits us in the face. We are going to have a one-time effect of this. That's going to be negative. Hopefully, we're going to get some trade deals on the positive side. The low dollar actually is going to help the multinationals on their earnings. But earnings estimates are still not going to be anywhere near as high as certainly what we thought in February.